Hello, and welcome to the Consumer VC. I am your host, Mike Gelb, and on this show, we talk about the world of venture capital and innovation in both consumer technology and consumer products. If you're enjoying this content, you could subscribe to my newsletter, theconsumervc.substack.com, to get each new episode and more consumer news delivered straight to your inbox. My guest today is Shea, managing partner of Divergent Capital. Katie has had a lot of experience investing in both sides of the table as a founder, operator, angel investor, and venture capitalist. Some of her investments include City Row, Parade, and Topicals. We discuss why and how she launched a venture fund in the middle of the pandemic, how she approached angel investing, where the bar is for digitally native brands, and much, much more. Without further ado, here's Katie. Katie, how are you doing?
I'm doing great. It's been quite a while since we last caught up.
I know. You were supposed to come on the show like 6 months ago, and I'm so excited to have you on. This has been long awaiting. Samara was very sweetly put us in touch, and it's been really great to get to know you. But get me up to date. What has happened in the past 6 months in your life?
Yeah, it's been a roller coaster for sure. I appreciate the patience with me. I think I had to reschedule because I was about to give birth to my second. So that's probably the biggest life update. Now I have two kids, 2.5-year-old and almost 6-month-old. So it's been a lot. I joke that if I'm not covered in poop or puke, I'm on a LP pitch or a founder call. So just mixing everything together. And I launched a fund, which has been kind of a long time in the making. I partnered up with a good friend, turned co-investor, turned lifelong professional marriage, this amazing woman, Lucy Wang. She's a machine learning scientist turned investor. She was first investing at Greycroft and then a smaller deep tech fund called 11-2 Capital. I think you know more about my background, but I came into venture very much from the founder and marketing side of the house. So I spent my entire career launching and scaling startups really from that 0 to 30 million in revenue stage before I started angel investing and before I got into venture full time. Lucy, totally different, very complementary skill set. She's the CTO to my CMO background. She's kind of the entire ecosystem's go-to on robotics, machine learning, AI, totally my better half. So we've known each other for almost a decade. It's kind of a partnership that I think had always been in the back of our minds. And then we decided, hey, global pandemic, this is the perfect time to raise a debut venture fund. But yeah, we did it. And so we hit the ground running, really started deploying in March. And definitely a labor of love, but every day we're getting kind of more and more excited about the partnership thesis, the companies we've invested in. So I joke with everybody that the last 12 months was my most productive year. It grew like a human baby, a venture baby, tried to potty train another baby. It's all downhill from here.
That's amazing. Well, first of all, congrats for having a second child. That's amazing. As well, launching a fund. It's so interesting because I've even talked to other people in certainly different capacities, but it's when the world seems, quote unquote, ending or something is, catastrophic as, global pandemic, then sometimes you maybe realize, okay, well, what do I actually have always wanted to do, but never really thought about the opportunity, whatever. And so I feel with Divergent, it kind of seems maybe that as well, along those lines.
I completely believe that this 2020, 2021 vintage is going to be a 2008, 2009 vintage for a couple of reasons, right? We could be wrong. We're pretty confident. And I think the main reason why is when you think about both on the founder level and the fund manager level, I think there's a lot of people most years where you're oh man, I want to go do my own thing. I want to start a company. I want to start a fund. I think it's really the true crazies that actually do it when the world is full of volatility, right? I think all of a sudden you're civic unrest, political unrest, global health pandemic, I'm just going to stay at my cushy job at Google or my cushy job at a tier one venture fund. So I think a lot of the companies and the firms that basically were founded over the past 12, 18 months are really being led by people who literally could not see themselves doing anything else, right? Like they were willing to take the risk. They were willing to work harder and, do whatever, raise, start during a pandemic. We'll see if that comes to fruition, 10 to 15 years from now. Venture is a pretty, long tail industry, but I don't know, that's what I'm seeing from founders and managers. It's really the true crazies that got out there last year.
Yeah, no, that's a really, really good point. I love that idea. And especially I think it holds true when you do have a pandemic, the true crazies are going out there. And I also think, right, if you're able to survive something like the pandemic, it could be that your competition's washed away. Right. And so there's just enormous opportunity for that as well. Speaking, just because your backgrounds are a bit different between you and Lucy seems to come more of maybe a deep tech background. How are you thinking about opportunities and what overall is your thesis?
So it's so interesting. So when Lucy and I first met, there was no professional overlap. We met at a tech conference, we became friends, and we never talked shop because Lucy was a deep tech investor and I was a consumer generalist investor, right? Lucy was kind of chasing PhDs, commercializing their life's work out of universities. And I was chasing people leaving Facebook and Spotify and whatever to go build the next unicorn. So it's really interesting. There was no overlap in the beginning. And then really, I think the initial kind of starting light bulb for Divergent is that we noticed that changing a couple of years ago. So what do I mean by that, right? All of a sudden, Lucy would meet with the founding team and it was a robotics company. But instead of the founders wanting to do that super safe deep tech business model, the robotics as a service route, the founders wanted to own more of the value chain, right? And have the robotic cells themselves and sell directly into OEMs. And so she'd be like, this is super interesting. She'd call me and be like, how does go to market work here, right? Who do they sell into? What is the buyer persona? How does that buyer persona think about ROI? On the flip side, I was starting to see, for example, the founder of a digital healthcare company, but at the core of the technology was a really complicated machine learning algorithm that was way above my pay grade to know if it was good or bad, or there was hundreds of competitors. And so I started calling Lucy more and more often. And I was like, hey, I like these founders. I like these markets, but can you help me out with the tech? And literally a 10-minute call with Lucy was the most productive, efficient way to get ramped up on something that I didn't know. So I think that just started to happen more and more frequently, to the point where we started to almost feel we were becoming each other's superpowers, even though we were at different firms. And I think it really, a couple of things that really got us over the edge. So Lucy and I, we'd talk about these companies. We would both get super excited about them. They didn't perfectly fit in either portfolios, right? These were companies that didn't perfectly fit in a deep tech portfolio. They didn't perfectly fit in a consumer generalist portfolio. And so we would share the opportunities with our peers, with our other friends who were investors. And everyone was there's too much risk. There's tech risk and there's business model risk. I now have a $1 billion fund. So I'm just going to wait and see until one of those risks diminishes a little bit, because, I have to deploy a $3 to $5 million check to make my portfolio construction model work anyway. That was super interesting to us as feedback, because we're wait a second, where is the brave capital in the market that's willing to go super, super early, pre-product, pre-revenue? And I think that never scared us and doesn't scare us today, because I have this CMO skill set, right? I can underwrite, go to market and CAC to LTV. I can log into a Facebook ads manager account and see if things are going well or not well. Lucy, she knows tech, she knows the science. And so she can really underwrite that side of the house. And so for us, we're we can be brave and we can go early, because we don't have to rely on all of these third party, experts or things like that to get to conviction. So that was happening. I think, last but not least, Lucy and I have always, we bonded on this over our whole friendship. We've definitely always been investors that were pounding the table for the not Silicon Valley cool kid founder, the young hustler who just graduated from school, but is a complete visionary, but doesn't have a track record or a pedigree to underwrite, or the PhD type that doesn't speak VC, but actually is the world's expert on whatever it is that they're working on. And so I think for us, we're there's there's actually a bigger opportunity here. So we started angel investing together from a shared LLC like about 2 years ago, like small checks, personal capital, somewhat capped from like a personal liquidity standpoint. But we just want to really pressure test like the partnership, the thesis, pre-product, pre-revenue, like true pre-seed. Can we basically find these companies, help the founders put the rounds together, and like see what happens if they work? So that's what we did. We invested in 5 companies, pre-product, pre-revenue. That early portfolio is now like a 73% IRR. So it's like, obviously it's a long game, but like early signs are looking good. Kind of around like, hey, where do we get excited? It's usually the intersection of like a tech or science that Lucy knows really well and a market I know really well. So high level, the first 5, we have a robotics company. It's in the sheet metal formation industry to start. We have a predictive analytics platform that's using machine learning and natural language processing. It's selling into universities to help predict and prevent student dropout, which is a revenue churn problem for a university. We have a software-only medical device. We have a science-based skincare brand, and we have a material science innovation that's targeting like replacing single-use plastics. So pretty broad, like we say, pre-seed generalist, but usually with a bit of like a tech or science edge to it.
That's really, really interesting. I'd say since you invest so early, it seems like you have to be very, very hands-on with some of the founders, right? I'm just kind of curious, how are you thinking about structure in terms of number of investments you want to underwrite? So how do you think about how do you spend your time, if that makes sense?
Yeah. So to your point, we're going to be fairly concentrated, so 25 companies over the life cycle of the fund. I think it's, probably like most investors, I think you kind of like dip in and dip out as needed or as your skill sets like require or when they're helpful. So I think for Lucy and I, it's 3 main pieces, right? For me, it's really like those early couple months of like, hey, you need to go from 0 to $1 million in revenue, like ASAP. Like, what is the budget that you need? How do we kind of put KPIs in a spreadsheet? Like, who do we need to hire to get this done? For Lucy, it's almost that like similarly, like those early months of like, hey, we can't afford the $300,000 a year CTO yet, but like Lucy can kind of come in and say like, hey, like this is how you want to set the team up. Like this needs to be the inputs of the algorithm. Like this is the data you need to be collecting. Like both of us can be like, hey, here's where we messed up like many times. So let's save you like the tears and the trials and the tribulations. And then raising follow-on capital, right? Lucy and I, one of the biggest risks that we're underwriting is follow-on capital and dilution over time. So Lucy and I have been doing this for a long time, both of us almost a decade, as angels and as VCs. And so kind of, as I mentioned earlier, like some of the founders we're investing in, they don't have that network. They don't know like what the milestones they necessarily need to hit or like who the right VC is to like lead the seed or the Series A. So that's another huge area where we get involved, like most investors, right? Like we just did this last week with one of our companies. They just signed an amazing Series A term sheet. But yeah, we worked with them on the deck and the narrative and emailed, dozens of our friends. We're like, hey, take a look at this. Like, we think this is right, like spot on for you. So I'd say those are really kind of the 3 key areas. But we have a little bit of a contrarian perspective on like formal board governance and board seats at our stage. If we have a super relevant skill set and the founders like begging us to do it, like, of course, we're not going to say no. But we kind of think board seats at pre-seed are a little bit more about like VC ego than like actual like value. It's like save it for the seed or the Series A, which again is a bit contrarian. But I think the reason why Lucy and I feel really confident that we can do that is because both of us are like founder operators turned investors. Like we tend to get the like midnight texts and phone calls anyway from the founders. Like we're talking to them at least monthly, I'd say at some points weekly, some points daily, depending on what's going on. That's the type of dynamic we want to maintain, right? Is like, listen, you don't have to posture with us. Like I'm actually much more interested in knowing like what's not going well and like what's keeping you up at night versus like all the great things you're going to try to tell the board is happening.
That makes a lot of sense. And, I guess focusing on some of your consumer investments as well as maybe how you're thinking about consumer right now. We went through, and of course, you're a growth marketer, so you know about this way more than me, but we went through huge arbitrage opportunities and growth, late 2000s, early 2010s, when I feel like a lot of like the companies, the disruptive companies, it was because supply was so small online and you had almost endless, what seemed like maybe endless amount of like media inventory, you might not really have needed much like product innovation. And now it seems like, especially the companies that you're talking about that are consumer facing, it seems like there is certainly a lot that goes into the product and product innovation. I'm kind of curious, how do you approach consumer right now? Because we've also seen as well for COVID, like a tailwind for e-commerce. And there's been some chatter about how is like late 2000s, early 2010s coming back, right? With like that arbitrage. But I would just love to see in this day and age what it takes to build like a massive consumer business.
Yes, I am so fortunate. I've gotten to invest in founders of Topicals, of Parade, of House, of Bomba Socks, Clean Colt. Like some I think of these like category defining like D2C companies that are ramping up to tens of millions, hundreds of millions in revenue really quickly. So it's interesting. To your point, like the first investment I made on the consumer side was in 2014, right? So like coming up on 8 years, right? And that's actually first unicorn, like all the good things that are like dangerous because you're like, oh, I'm really great at this. Everything I'm going to invest in is going to become unicorn. So let's see. I think I can do this in a few ways. I think consumer or not, for me, I'm obsessed with founders that are really trying to solve a problem. And so I think that can look different in different categories, but especially in markets like this, which are quote unquote frothy, even though I kind of hate that because sometimes founders are like, if there's so much money out there and it's so frothy, like why is fundraising still so hard? So fundraising, I think, can still be hard, even in a quote unquote frothy market. But in markets like this, especially, I think it's nuanced, but it's there, right? There's a difference between a founder that wants to start a company and a founder that wants to solve a problem. I think personally, I feel like I can like tell somewhat quickly on like what type of founder that I'm talking to. The former is like, oh, I want to be my own boss. Like I have a lot of friends in venture. If I can just kind of like create a deck and get this thing started, like great. I think the latter camp, it's like, it's David Bombas. He found out that, the number one most requested item at a homeless shelter was socks, right? So he like got off the ground with this like one-to-one, buy one, give one model. Cami at Parade just had this incredible like David and Goliath, narrative on like Victoria's Secret has been responsible for like decades of women's eating disorders. Like, how is this still the like underwear brand? It doesn't speak to millennials. It doesn't speak to Gen Z. I think I'm really looking for like that visionary founder that like just experienced the problem firsthand, like has a unique way to solve it. And it's just going to be that like absolute visionary, right? Olamide at Topicals, she is incredible Black founder. Every single item in the ointment aisle is basically built for white skin, right? Like acne scar and hyperpigmentation, eczema. She's like, I'm going to go build a brand for me. I think when you have a founder that is very similar to the customer, you save yourself a lot of time and energy and money making mistakes on what the customer might want because they are the customer. They kind of like know what that person wants. I think the other thing that a lot of these breakouts have done really well is like they've created this cult community around the brand. Particularly, I'd say the brands that are focusing a bit more on like Gen Z, like it is wild, like how much like micro influencers are moving the needle for some of these brands, right? Like they're not even looking to get paid, right? They just want to feel like they're part of something cool. They gift product that like the cost of that is like a couple of dollars, and they post it on their Instagram account and they have whatever, 5,000, 10,000 followers, and they have some type of rev share. That's been super powerful. So I think it varies, but at the end of the day, for me, it's always going to be founder first. There needs to be like an obsessiveness with the product that they're building for, like nuanced perspective on who their customer is and what their customer wants. And I think from there, it's like the product has to be a best-in-class product. I think in like the heyday of when like Facebook and Instagram was super cheap, like you could get away with a mad product. I think today the breakouts are like you get that product and then you tell 5 to 10 of your friends about it, right? So you have that like virality coefficient to all of your paid marketing? What do you think really moves the needle? It's funny, when I first met, I was friends with Dave, and when he first told me he was starting a sock company, I had just sold my manufacturing company, and I was like, dude, like, why are you doing this? I was like so jaded. I was like, you're so smart. But then he sent me some samples of the socks, and I was like, oh my gosh, like, I'm never going to be able to wear another pair of socks again. And like, to me, that was really the closer, right? Of like, wow, like, you touch and feel and hold this product in your hand, and you're like, this is a great product. So I think it's more than ever, like, that virality coefficient is important now that, to your point, you're seeing like Facebook and Instagram CACs like 10x what they were 5 to 7 years ago.
When you're underwriting risk, and if it's a brand that, for example, the founder is very much attached to the brand, like maybe the founder is becoming a celebrity in their own right through their brand, if that makes sense. How do you think about that? Is that a good thing? Is that a bad thing? Is that can sometimes be a little bit unnerving?
I think my founder type, like, they kind of know that they need to be a bit self-promotional to like get this thing off the ground, but they're actually like not at all obsessed with that. And even within my portfolio, I have different variants of that. Like David Bombas, Ryan at Clean Cult, I'm not even sure they have social media profiles. Like Helen at House, Cami at Parade, Olmani at Topicals, they're definitely a bit more of like the face to the brand. It's interesting. I actually haven't noticed until I just said that out loud. Like there is a gender component to that, where like at least in my portfolio, the female founders seem to be a little bit more attached to the brand. But I think that also makes sense, right? Like if the majority of your customers are female, like that's a part of like the inspiring story, right? It's like, I'm buying from a female founder, right? That's like kind of changing the ecosystem. So I don't know. I definitely want to invest in a business that, even without that founder having to be everywhere, the business is going to work. And I think that comes back to your earlier point on product, right? The product, like the bigger the business gets, the further and further customers get away from the founder story anyway, right? So I think it's like a great way to get from like 0 to 10 million in revenue, 0 to 15. But at some point, like something about the product and the brand needs to be resonating outside of that founder narrative. So I don't know if that's particularly insightful, but that's definitely one way to think about it, and kind of how I've thought about it as well.
No, that makes sense. I mean, I guess when you're thinking about the long run, especially if you want to build a business that can achieve venture-backed returns, I think to your point, the product has to be incredible. Like maybe you can do quite well based off of the marketing and the branding in the early days. Obviously, those have to be great as well. But the product and that experience, that delightful experience, like when you open Bombas for the first time, for example, right? When you actually, that product really has to grab you. And that's really almost like the long-term like competitive advantage that you have. Yeah,
totally. And again, like I think, when I think about like next generation commerce and like kind of what we're thinking about on the Divergent side of the house, I'm very intrigued about like stigma heavy brands right now and like consumer opportunities. So like, I think Parade is a decent example of that. Topicals is a decent example of that. Even House, right? Like it's booze, it's underwear, it's like ointment for like skin issues, right? And I think when you have this like some type of like extra barrier of difficulty that the brand needs to like jump over to work, it's even more powerful on the community side, right? Like, cause like someone that buys Parade doesn't just feel like they're like, oh, I'm like buying some new great $9 underwear and it's like more sustainable. They're like buying into the story of like the new American underwear story. Like Cami says that a lot, right? Like taking down the bad guy, Victoria's Secret. Topicals that's similar, right? It's like you walk into a CVS and like nothing about the formulations in any of these products on the shelves right now have been updated in 30 or 40 years. They're made for like light people. Like that's not what the world looks like anymore. So I think that's something that Luce and I are kind of thinking about on like the next gen commerce and like where these cult brands come from. And I think for us, we're definitely more intrigued right now if we think there's like a stigma or like a David Goliath story, because Topicals, right? It's like, I think what they're doing for skin empowerment is what like some of the brands have done for like body empowerment before, right? It's like, why is perfectly clear skin the most beautiful skin, right? Like we all have acne or eczema or dry skin or whatever, and kind of just like normalizing that journey. So, that kid now that's like literally on social media starting at the age of 7, which is like petrifying, has a little bit more of a representative worldview based on the brands that they're seeing.
Totally. I absolutely agree. And gosh, I wish we had this conversation a month ago because I would have invited you to speak if you be game at the Sigma Summit, which was 2 weeks ago. We had brands and investors all talk about categories that were heavily stigmatized, which was a lot of fun. So we'll definitely get you next year if you're game to be the speaker at us. That was a lot of fun. But how are you seeing, and I appreciate you, how you thinking about as well, like new developing markets and thinking about what's wrong with the current players in the market, right? Who are they not serving? And I think topicals was an excellent example in that way. How are you also seeing brands, like interesting ways brands approaching growth? Like there's a lot of talk, a lot of buzz about community. You need to build a community, but I'd love to kind of hear, especially as someone that's, a prolific marketer like yourself, how are you thinking about some of how these new brands are approaching growth?
So it's interesting. If I had to talk about one thing here, what the difference that I'm seeing like in kind of in the market, like, companies that they're growing, they're going up to the right, and like the true breakouts, like clearly on that venture scale of like 5-10 million in year one. Honestly, like these brands they're pumping out so much product. Like, I think like the days of like single product or like small silhouette or like kind of small capsule collection are gone. Right. And like where I've seen the most success, again, I've invested in like 50 companies now, not just, brands exclusively, about half of them personally, and then half as a VC. That is where I'm seeing like true sales velocity come from, right? So like going back to like Parade, right? Like they literally launch like a new brand almost like every single week. Like they have Lease, and then they have Sport, and then they have Pastels, they have Days of the Week. And so like they have this diehard customer, and then they add something new that they can buy like every 2 to 3 weeks. You see the same thing with House, right? Like they rely more on like new flavors, right? They have like this starter sample pack and like try your own flavors. And then every month they kind of have a new flavor. So like if you have these customers in the door that like the brand, like the product, I'm seeing that work really well. So to me, it's like more and more of a reliance on an exceptional product development team that's almost like cranking out new products definitely more than the incumbents. But that to me is where I'm seeing like real LTV expansion. And then it feeds on itself, right? Because for any like performance marketers, this is not particularly novel, but when you have that type of like velocity of new product launches, flavors, like whatever it is, you can build stronger and stronger lookalike audiences based on your highest LTV customer, right? So like the higher and faster you can get that high LTV customer and like start to build lookalike audiences off that customer, it's like becomes a beautiful kind of system in regards to paid complementing organic complementing paid.
This reminds me a little bit of actually a conversation with Megan Bent at Harbinger Ventures. And I was wondering, how do you then, if brands you see are releasing a lot more SKUs, how then as an investor, are you thinking about operational efficiency versus maybe like brand efficiency? Because of course, I'd imagine you kind of run into a bit of a problem there.
Yeah, I think I'm more like known on the performance marketing side now, but I started a manufacturing company in college and we sold it in 2013, and it was very different. Like we never raised capital. We bootstrapped to profitability. We factored against our receivables to grow. We sold to like the Neiman Marcus, Macy's, and Bloomingdale's of the world before all of those like went out of business. So it was a very different landscape. We got off the ground in like 2008, 2009. But to that point, I have been in so many warehouses in my career. And like we switched our 3PL 3 times. We worked with, international distributors. We did home shopping channel. We did retail. We did direct to consumer. It's a logistical nightmare. So it's interesting. I hear this a lot from my founders that I tend to dig into like ops and supply chain more than some other consumer investors, because I know that like if you're on the venture path and you miss a month of like 20 to 50% month over month growth because you were sold out of your bestseller, like that really sucks. So all to say, just for me, what that looks like in practice is like, I want as much confidence on that like supply chain founder or that ops founder or that hire as I do on like the once in a generation brand builder, right? Like I think my for lack of a better word, like my unicorn co-founding team is like one of both, right? And like the roles are clear. And so when they are disagreeing with each other, it's not because they both think like, oh, I know what I'm talking about brand, or like I know what I'm talking about supply chain. Like tends to be founders like have swim lanes and like fundamentally respect the other one for their swim lane, right? It's like, of course, there'll always be disagreements at like the founder level, the C-suite level. But at least for me, I've seen that dynamic work really well. And it's hard. Like it's really hard. I have a couple portfolio companies now. They're like, we need that ops person now. We could like manage this with our 3PL with a couple $1 million a year, trajectory. Now we're doing a couple $1 million a month and shit's breaking. And so it generally, I think generally the solve is you have to go hire somebody that's, unfortunately poach somebody from a company that's, a couple $1 million a month ahead of you, right? So you can basically like take that person's playbook, figure out all the mistakes that they made and kind of apply it to their company as soon as possible.
When you're thinking about investing at the early stages and as well as brand building, and I guess maybe this ties back into the operational efficiency question, but do you look at brands that actually are cross-category?
I haven't, or I should say I probably looked, but I haven't invested. I don't think that candidly was like super intentional. I think it just comes from the place of like, I know how hard it is to kind of get from like the 0 to 1 on the product development side of the house. And just generally, I orient towards and I guide founders towards like focus on one category, like be the dominant player there and like then think about expansion across categories. I've seen that work better. I think that was my bias operationally. I think the hardest thing for startups is to focus, right? Like I think the best founders like say like one yes to every 99 no's, right? And it's like, that's kind of the rigor I think you have to have in those early days to not get off track.
Those are good points. I mean, just in terms of how you also see, can you really master or create maybe one product in a particular category rather than going across category?
I think another piece of that is like what I usually want to see and hear from founders is like, we're going to actually let our customers tell us what they want next versus kind of like from day 0, like speculating on what that might be, right? So I've seen that work better strategically versus like, hey, we think they're going to want these 7 things across category, like public goods, the brandlesses of the world, like that's just a totally different strategy, right? There's also something to be said of like, it is so miserable and painful that if you figure it out, like you have your moat and like, yeah, maybe you don't have a ton of M&A, but you get to a couple $100 million a year in profitability and like you have an IPO route, right? Like Figs is a great example of that. So personally, I've tended to stay more in like a focus on one sector first.
Well, bringing up Figs, has that changed at all how you think about e-commerce and maybe when you think about investing in brands about whether or not they should go to retail earlier or later, or if at all?
Yeah. It didn't change much for me, but I think it changed the narrative slightly for a lot of other investors. I think there's definitely been this like serious cool off of venture wanting to touch CPG, which I understand. But I hate to say this because the bar just sounds so high and I think intimidating, but like the only way consumer, like not consumer tech, like, right, like straight CPG makes sense is like, if they can really get to like close to a $10 million run rate year 1, like that sounds insane, but like that is like the bar, right? Like 5 to 10. And that's kind of what I'm looking for. Like in some insane combination of everything going right, can this company do that and like really be off to the races? I think the other thing to consider is capital efficiency with these types of businesses, right? Like best case scenario, usually you're talking about 3 to 6x revenue multiples. And so like there's outliers, but like that's kind of how I think about exit outcomes. And so you have to figure out like how much capital do you need to be doing $300-400 million in revenue, and does it still make sense to like start and run this business, to that point, right? I think the line is a little harder on, hey, we want you to be profitable or close to profitable for consumer businesses than it is for SaaS software, kind of a whole other host of business models. So I don't want to like scare the crap out of anyone of like that. How is that even possible? And like, but I think I've at least seen you really know that you picked a winner when you're doing kind of multi-millions of dollars a year, right? And kind of like year 2, year 3. And don't get me wrong, like I was raised by entrepreneurs and small business owners. Like I have nothing against lifestyle businesses. Like I think they're incredible. And I think that those are the right types of businesses for 99% of people that think they want to start a business. But I'm strictly speaking into like what makes sense for a venture portfolio.
Totally. And you're a venture capitalist. So that makes a lot of sense in terms of what you would actually invest in versus what you wouldn't. What is one thing you would change about venture capital?
There's so much ego. There's so many things I would change about venture. It actually shocks me that I've landed in this asset class. Like my dad was a firefighter, a small business owner. My mom was like a stay-at-home mom of 4 turned teacher, both incredibly entrepreneurial, but like I did not know what venture capital was for most of my life. Everyone, I admired and aspired to be was a small business owner, right? With like a cash flow positive business that was paying their mortgage and sending their kids to college, like based on that cash flow. So for me, it's like pretty shocking that this is like what I do full time. I think I love the founders. I love like people that literally like put everything on hold and like risk everything to like go after a big idea. I think it is so brave and so inspiring and like so energizing to be around people that are doing that all day. And I think the stage where we get involved, as far as the cap table goes, we are as close to aligned with the founder as we could ever possibly be, right? So like the incentives at the very beginning, I think are really aligned, which is why Lucy and I want to stay there, right? Like the earlier, the better. We don't aspire to have like $1 billion fund with a huge platform team, right? Like we love kind of working side by side with the founders. So I don't know if that answers your question, but I think the egos are what really like I struggle with the most. I find it kind of funny that like anytime you have like a success story, right? Like a multi-billion-dollar outcome, an IPO, Twitter blows up, blog post blows up on like, we called it, like we knew that this was going to happen. And like, I think the reality of it is VCs are mostly wrong, right? Like, let's just say you do have a 25 to 35 company portfolio, which is probably average across the industry. Chances are 1 to 4 of your companies are going to make up all of the returns of your fund, which means you were wrong like 75+% of the time. So to me, just like that statistic next to the egos is like the intellectualization of everything is kind of like my biggest pet peeve. And I think from an ethos perspective, Lucy and I are really similar there. Like if we have 30 minutes to kill, like we're not going to get in a Twitter fight. We're not going to write a blog post. Like we're going to call a founder that's having a bad month. And like, that to me is just more my style of venture, I guess. But sometimes I definitely feel like we're a bit outliers there. Lucy doesn't even have a Twitter account. She might be the only VC I know that doesn't have a Twitter account.
That's awesome. I think that's very, very true in terms of the ego and what you can see on Twitter. Because as you say, it's an outlier business, right? I mean, only if you invest 25 companies, probably 2 to 4 will survive or will able to get you the returns that you need to. What's one book that inspired you personally and one book that inspired you professionally?
This is not a good question. I don't know if I've read a book in years between having 2 babies back to back, raising a venture fund. This is not professional at all. The last book I really enjoyed reading was called Expecting Better. It's a pregnancy related book. And actually Haley at First Round is the one who recommended it to me when I told her I was pregnant. And so basically it's this badass woman, Emily Oster. I think she's like a behavioral psychologist, right? She's kind of like a world-renowned professor. Basically, she kind of like chapter by chapter breaks down like the math and science behind all these pregnancy related rules. So like no drinking, no sushi, like no coffee, like kind of all of these things, which to me was just so refreshing because it's like, I'm sorry, like I'm a 30+-year-old woman and like you're all of a sudden telling me I can't do all these things, but no one can explain why. So she kind of just like dives into the science and data and like public medical like results and records and things like that. So that's the best I can give you for an answer. And that's probably incredibly indicative of the life stage that I'm in.
No, thanks for mentioning it.
Yeah. I think also for me, like I'm a total workaholic, and I feel like my every day, night, weekend, somehow is like work related, because venture is also it's a social job. So between happy hours and the dinner. So when I do read, it's very intentionally not business. My husband and I are listening to Matthew McConaughey's book, Green Lights, on Audible, I guess, in the car, when we're in the car. And that's my jam right now. It's a pretty interesting story. He's an actor, but he has a pretty non-traditional background and upbringing. He's 50 years old. So he's kind of reflecting on all these stories about his childhood and not being an actor, but trying to be an actor. And then now all of a sudden becoming super famous, and just a lot of cool, professional and personal points there. So those are the books. Those are the books that are top of mind right now.
I think Matthew McConaughey has one of the most soothing voices. I listen to him in the evening on Calm, and I just think that it's just so relaxing and soothing. I'll certainly have to check out that one. My last question for you is, what's the best piece of advice that you've received?
This is so vague, but true. I definitely spend quite a bit of time debating on, do I want to start my own venture fund? Do I want to do it solo? Do I want to do it with a partner? Is a global pandemic the right time? Does the world need another venture fund? It's something I came back to time and time again. And I talked to so many, we're super lucky. A lot of our LPs are also the founders of some of the tier 1 venture funds. So they're not only capital partners, but they're a decade, 2 decades, 3 decades ahead of us in regards to their experience, and just going for it. There's never a good time, right? And I was I literally had just found out I was pregnant. It was kind of there was so many reasons. My husband started a retail tech company, and he just raised his seed rounds. Between the two of us, it was just utter chaos for a year. And I don't know, I just think if you feel you're born to do something, and you're losing sleep over the fact that you aren't doing it, save as much money as you can, move back home with your parents, and just do it, give it a shot. Give yourself a timeline, right? If in 3, 6, 9 months, things aren't looking good, call it quits, but at least you'll know that you went for it. So yeah, I feel we got last year got some just great pushes from people of just hey, you're good at this. What are you waiting for? And I think, unfortunately, I needed a little bit of that external validation to do it.
No, that's great though. But you did it, and now you have a fund, which is awesome. And also, I really enjoyed learning about the thesis, and as well as how it all came together with you and Lucy. That's fantastic. Well, Katie, this was so much fun. Thank you so much for your time.
Yeah, thanks for having me. This is awesome. And thanks for waiting 6 months to get it done while birthed and fed a new human for a while.
And there you have it. It was terrific chatting with Katie. You can follow her on Twitter at Katie Shea Says. I'd love it if you'd write a review on the Apple Podcasts. You're also welcome to follow me, your host, Mike, on Twitter at Mike Gelb, and also follow for episode announcements at Consumer VC. Thanks for listening, everyone.